A lot of economic textbooks are just plain wrong on this subject,
Really?
fractional reserve banking. So they talk about things like money multiplier effect and so on. This has been widely debunked. Similarly, some people say, well, banks use the deposits that you put in there as a customer to lend out. That isn't true either. Those are just reserves. Fractional reserve banking is the creation of money from nothing. So whenever a bank takes in $1 in deposit, it has the ability to lend out $10 in the form of a new credit financing when it lends money to people. So it's created $9 of new money in the process. Where has this money come from? Literally from nothing. It's alchemy. It's magic. So, if you were a Martian arriving on planet Earth and you saw how the banks functioned, you would probably conclude that there's a sort of fraud taking place here. And it is, but it's a legal fraud.
Yeah.
They're allowed to do this. So that's what fractional reserve banking is. The question is, what are the alternatives? We talked about fintechs last time, financial technology, and we mentioned some of the conventional fintechs like Revolut and Monzo and Starling Bank.
Yeah.
You open an app on your phone and you can do your banking and other transactions. Yeah. And the Islamic finance community is starting to set up new companies, Islamic fintechs, that do specific things. Let me highlight a couple of those.
Please.
One that I like very much and I support very much is FIDA, P-F-I-D-A.
Yeah.
FIDA are a home financing company. These fintechs exist to satisfy a specific need. And the need that they satisfy is financing the purchase of your house.
Mortgages.
Mortgages.
Yeah.
And they do a debt-free home financing.
Okay.
It's done on the basis of a participation, which I'll talk about in detail later.
Yeah.
That's one example of a really good Islamic fintech that's addressing a specific need that Muslims can get their financial services. I have set up a company with my co-founder called Cordova Capital Markets, CCM. And this is a company that finances working capital and trade finance in international businesses. And it does so also on a participatory model.
Right. You mentioned the word a participatory model. Do you want to just explain what you mean by that?
Yeah. A bank has a relationship with a borrower that is asymmetric. The bank is the lender, the borrower is the borrower, and their asymmetric relationship exists because the bank has the power and sets the covenants and decides how the loan will be paid and what collateral and security is in place.
Right.
When you finance an individual or a business using participatory finance, you're saying, I as the financier will give you some money and I will take a participation in the profits or losses of your business venture. And I'll analyze that venture better than a banker would because I've got skin in the game now.
Right.
It's not a case of you have to pay me whatever happens, come hell or high water. And if you don't, I'll have the shirt off your back. So participation is about aligning the interests of the two parties as partners in a venture.
Right. Said at the end there, the Islamic economic model is one where there is an engagement with the real economy and there's risk sharing.
Yeah.
So let's talk about risk sharing. Explain that to me, please.
I think Allah wants us to strive. Yes. He wants us to be of benefit to humanity.
Yeah.
And that's a form of worship, actually. I think striving in your business to be a benefit to your community, to your family, to your neighbors, to society is itself a form of worship.
Yeah.
If you have that intention. That's what I believe.
Yeah.
And I think taking risk is part of the natural state. It's like our fitrah. It's our natural human state to want to take risks for the betterment of all. Risk sharing is natural and healthy. I think if investments were socially impactful, if they were commercially viable, we would have a healthier economic system. What we have today is that we throw money at commercially dubious and socially useless ventures. So in the financial services industry, there is a type of institution called a venture capital firm, VC firm.
Yeah.
And these are firms that pool investors' funds and invest in early stage companies, startups often.
Yeah.
And typically their hit rate will be 1 in 10 investments will come good.
Yeah.
So they're throwing a lot of money at bad investments. This is rather odd to me. Why does that happen? Why do we have an economic and monetary system in which VC firms are throwing money at socially useless and commercially dubious ventures?
I mean, surely they don't know at the start whether these are dubious investments.
They don't know at the start, but they seem to be pre-programmed to throw their money away.
Right.
And the reason why I believe they're pre-programmed to throw their money away is because the money supply is inflated.
Right.
The money supply is inflated because there's more money in circulation. If you leave money sitting in cash in a bank account, it'll devalue very fast. The government tells us the inflation rate is 3 or 4%. That's not true at all. In fact, if you add up the basket of everything that we actually do pay for, our mortgage payments, our energy costs, our grocery baskets, etc., you'd probably find it's a much higher number than that. And that money sitting in the bank devaluing at 8, 9, 10% per annum, at least in recent years.
Yeah.
So the VC firms are almost incentivized to throw money away before it devalues. They have to find something, anything to put their money into. So they throw it into high time preference projects, projects that they think will earn them a quick buck. They don't think for the long term. They don't have low time preference because their money supply is not low time preference. Right. If their money supply was sound, for example, if we had a gold standard, and for thousands of years we had a gold standard. And the funny thing is, there are actually hadith that alert us to this. If you bought a piece of livestock, say a goat or a sheep, 1400 years ago, you would pay roughly the same in gram weight of gold for that livestock as you would today.
Yeah.
It's remarkable. If I held $100 in the year 1900, by the year 2000, it's worth only $4.
Yeah.
It's devalued by 96%. Since 1971, when Nixon removed the gold peg from the US dollar and allowed the currency to just be printed to finance a war,
Yeah.
we've had a reduction to 1/7 of its value in 1971 of the US dollar. So this is a clear theft of wealth from the people. And it's the reason why the financial services industry keeps proliferating debt. What's the easiest way for a nation to finance a war? Keep printing money and keep printing bonds.
Yeah.
So you keep having to repay the banks. But it's easy to repay debt when you inflate the money supply, right?
Yeah.
You've devalued money in the economy. The easiest way to repay the debt is not actually to repay the debt, it's just to devalue the money supply. So you print. We call this fancy names like quantitative easing. But actually it's money printing.
Right.
And we've come to accept this. So I think that's where we've got to, is that risk sharing is so central to investments, and we've moved away from risk sharing to an asymmetric relationship with banks, who are the master and we are the slave.